Welcome to TheoTRADE. This is Don Kaufman. It's November 5th, 2023. Doing the TheoTRADE weekend update here on a Sunday morning. Can the Fed-induced upside insanity sustain these markets? Yeah, clearly that's going to be the topic of conversation here on this weekend update. There has been a rip to the upside in the S&Ps, but before we get too deep into this, the reason I'm questioning what I kind of term, Fed-induced upside insanity, there's something I'm going to show you very specific inside of the bond market that, well, doesn't necessarily look as bullish. So the big question here in the weekend update, you see this rip to the upside. Okay, let's jump right into it. The rip to the upside, but markets were already in rally mode prior to the Fed. The Fed was just like pouring gasoline onto that fire, right? So, all right, Fed comes out obviously on Wednesday. Markets just explode off of some of the Fed rhetoric. Again, opinion piece here. I personally did not see the Fed as being dovish. Nevertheless, the markets, they loved it. They explode higher both on Wednesday, Thursday. Little continuation, of course, on Friday with the S&Ps closing up some almost 43 handles. So that's when opinion simply does not matter in a marketplace. But the markets, again, they were already in rally mode. In a complete and again very distinct and contrary position, I want to show you the bond market. And the reason I'm jumping immediately into bonds over here is they were absolutely not in rally mode. The bonds actually sparked the rally after the Fed spoke. And that's exactly what we're going to be looking at here, also in accordance with some volatility. So, all right, let's kind of switch gears, get into it a little bit, because again, everything really in the market right now is predominantly about, obviously, again, it's about Fed. It's going to be back to data. There's been some heavy sell side activity in markets lately. And that sell side activity, which is 2 weeks of a descent literally from, well, basically where we are, let's call it 4,400. We sold off into the low 4,100 in the S&Ps. And don't worry, because we're back. And that's why I'm kind of calling it Fed-induced upside insanity. One of the most interesting things of markets as of late, and again, this is simply one of the largest moves that we've seen to the upside in an extremely considerable amount of time. But one of the most interesting things is how just wild some of the moves that we're seeing. You look at this and you're like, it's a rally back. Like, people, look, this is as extreme as volatility gets. I don't care. People, they look at, the term volatility is always like sell side activity. And I would completely disregard that and just tell you that, look, it's just outright wild movement in the marketplace. And that is precisely what we're seeing here, is that 2 weeks of sell side activity is effectively erased in about 3 to 4 trading sessions. I mean, that's just the bottom line. And to look at this from a expected move, which is effectively a standard deviation perspective, without going into the exact mathematics of it, basically what you're looking at is, you're expecting about a $100 move and you got about a $240 move out of the week. Talk about getting something wrong, right? And it's incredible. And we're going to come back to this idea of, like, look how wrong the options market has been as of late. I think about that one for a moment, because we're going to actually loop back to it. So again, stating the obvious, we ripped to the upside. How much? About 240 S&P points. That's specific to the SPX. I'll be very clear about that. That's specific to the SPX. About 240 points to the upside on the week, when the week was actually expecting a $96 move. Now, again, the Fed speaks, the markets rip. That's the obvious. Okay. Then we're going to jump over here. Okay. And we can look at, S&Ps and spiders and, all the different markets till we're actually blue in the face. But before I do that, I want to actually jump over to the bond market. As I said, the bond market it's a little bit of contrast, because the bond market, again, it was not, again, categorically speaking, not rallying earlier in the week, like the S&Ps happened to be. And I say that specifically on Monday and Tuesday, the bonds were kind of hanging out. I wouldn't call this sell side activity, but the bonds were actually threatening the possibility of breaking lower, waiting for the Fed. Fed comes out, obviously the ZB explodes to the upside. But I have a different way to actually look at this, and I'm going to kind of combine a couple of the bullets from this weekend's update here. Again, I like to look at the bid under bonds, but what good does it do? Yeah, there's a bid under bonds. Who cares? Doesn't matter. I mean, look, that's stating the obvious, right? There's a bid under the bonds. I like to look at this first. I like to look at it from an expected move point of view. So the expected move, again, it's how the options marketplace is kind of handicapping, if you will, forward risk. And yes, the bonds ripped, but to show you again, on Monday and Tuesday, they didn't do much. In fact, you know what? I'm going to even zoom in here tighter and tighter on this so you guys can actually see exactly what I am referencing. But on Monday and Tuesday, the markets were actually effectively down very mildly. Okay, on Wednesday, there's a little bit of pickup inside of the bonds. But here's one of the key points: the bonds didn't really react. Interestingly enough, until Thursday. That's why I was said, like, it was kind of my opinion. I listened to the Fed too. And when I listened to it, I was like, I didn't really perceive it as being all that dovish. Okay, but apparently overnight the markets disagreed and we explode higher. But okay, again, an interesting point. The bond market, specifically here in the TLT, yes, it closed outside of its expected move, but not nearly as significantly as the S&Ps. And it's very likely that the bond market was trying to bottom, prior to this, got caught up in a little bit of a squeeze, if you will, to the upside. But here's even again the more interesting aspect. So I was looking at bonds, and then I'm thinking to myself, I wonder what bond volatility happens to be. So I look over at like TLT, and again, you can look at like ZB bond volatility, but I, over time, I find it easier to track TLT implied volatility because there's in the ZB, the contract rolls over. There's a little bit of inconsistency from time to time as the contract tries to roll over. Some of the option markets are not nearly as liquid in the back month, meaning that, for example, if you're in the bonds, the stuff that's further out in time isn't really liquid, so you're not getting a very detailed or marketplace, not as nearly efficient a look as TLT. So I use the TLT to gauge volatility in the bond market over time. And I can look at option statistics, and you can see the current historical volatility is extraordinarily high, but something caught my attention in here, and that's specifically that, yes, the bond market ripped higher, and unlike the S&Ps, the bond volatility didn't drop nearly as much. So I went over here and I'm taking a look at the volatility, and I'm like, I'm actually rather surprised. Like, this market, is it going to sound the all clear? And the answer is nope, it is not sounding the all clear in there, which is exactly why, I was kind of prefacing the discussion here, the Fed-induced upside insanity. I know you're thinking about, the S&Ps, and that's rightfully so. You should, right? It's a huge move up in the S&Ps. But it's, to me, the bond market is what's actually going to put the fear into the equity market. And that's what's been going on. And everybody loses sight of that, right? So you just all of a sudden you're looking at the S&Ps and you're like, they're up 240 points. And you lose sight of the fact that, yeah, but this entire, I guess, sell-off has nothing to do, and I'm talking about the sell-off in the S&Ps recently, has really had a lot to do with rates exploding higher and the bond market just crashing. The bond market gets a bid under it, right? From the Fed, and everybody starts clapping, and the S&Ps literally explode, and they just focus on the S&Ps, and the bonds go by the wayside. Don't let the bonds go by the wayside, because check this out. So we're actually going to come into studies. This might be off the side of your screen, but I'm actually going to pull up simply implied volatility. So we're going to pull up implied volatility. Then I'm going to come in here under equities, and I'm going to get rid of the volume, okay, just so you can actually see. All right, did volatility come off? Yeah, it came off. Did it come off a lot? Absolutely not. I mean, basically, the volatility is just simply like meandering. Now, the volatility that's here, specific to thinkorswim, is this is a 30-day VIX style implied volatility, right? So it's like 30-day vol. It came off, but like mildly. And the interesting and ironic, aspect of it is the volatility was already coming off prior to the Fed. It was actually coming off in a period of like consolidation of the bond market. So again, if you are looking for the one of the keys to the marketplace, the upside insanity to this marketplace at this point inside of the S&Ps, I'm going to just sound the not all clear at this point. So we could absolutely continue to see a bid under the marketplace, but I think you have to anticipate there's going to be a lot more volatility. That this one, of course, everything kind of ignites with it's a short squeeze, it's a gamma squeeze. Look, the bottom line is, okay, it's dramatic move to the upside. It's dramatic move to the upside with volatility coming in, and it came in pretty good. And they say coming in, that means VIX obviously coming down. Vol future is back in a very normal kind of contango. And this is where, again, trade tends to like high five, one another out there. But the bond volatility is, again, in my opinion, not sounding the all clear in terms of overall volatility in the markets, because when it comes right down to it, all right, we're a hop, skip, and a jump away from being threatened again. And in this case, I'll bring up the TNX. Here's the 10-year. So the 10-year, okay, and the 10-year during trading hours, the TNX has not necessarily. I mean, it touched into the 5%. Again, another opinion piece over here, but in my opinion, we got a crest through the 5% and a little bit then some before I think the fear and loathing of the bond market will reside. So be mindful of that here in just like right in front of us. Like I'm not worried, so much about down the road into December. I'm talking about right in front of us here because for the most part, you've got another 3 weeks of what could be some hostile markets here in the November timeframe. So again, Fed speaks, market rips, the bid under the bonds. Okay, the volatility check. Well, as we said, volatility is not necessarily backing off. There's another couple of interesting aspects in here before I get to disregarding Apple, is that a huge amount of the rally throughout the course of this week was in the financials. Now, bear with me on this thought for a second. You have to understand the ironic twist of the financials leading the rally. Now, what do financials always want? You're like, oh, well, they make money off of higher interest rates. What did interest rates do this week? Okay, let's go back to that for a second, because the ironic twist is, oh, interest rates actually went really far down. So as interest rates went down, you're telling me that the financials went up? Absolutely. And that has to do with unrealized losses in the bond market, which is, again, we're relating everything in the financials immediately back to the bond market as well, right? So the financials, though, again, opinion piece here, probably in extraordinarily oversold conditions, which, looks like they were. I mean, what did the financials go through? I just got tormented for 2 weeks, the lower edge of the expected move. This latest move is basically, it's a 3 standard deviation move to the upside. So phenomenal move to the upside, but the financials are kind of the leader of the pack. And I started looking through some of the monsters of tech. And the monsters of tech, okay, yeah, Microsoft outside the upper edge of the expected move. But interestingly enough, Microsoft was already outside its expected move before the Fed even spoke. Apple, as I said, kind of disregarding Apple a little bit. The interesting thing about the move inside of Apple is Apple did trade down to the lower edge of its expected move. It just got caught up in the rally of the rest of the marketplace. There's nothing else to say about it, is that earnings did not matter. It's not about disregarding Apple. And I put there, would you just disregard Apple? No, it wasn't great. It simply wasn't great. But as you look around the marketplace, okay, you'll understand very quickly that, again, everything just basically got swept up in what is again, significant rally. Yeah, Tesla just basically hitting the upper edge of the expected move. And of course, NVIDIA getting swept up in the rest of the rally. And it was a rough start, actually, in most of the tech stocks earlier in the week. It was a very rough start earlier in the week, and everything, as I said, gets swept up in the rally. Don't get ahead of yourself. You got to watch that bond market. If the bond market continues to rally, I think that the S&Ps could have a little bit more upside, but it is those bond markets that are going to discern what the future looks like of those S&Ps. If the bonds flip back over, see any sell side activity, even early in the week, okay, that's a threatening gesture. I think it's going to be a wonderful opportunity to actually short into the S&Ps. One of the things I'll be looking for is early in the week, I didn't go out and sell very much premium later in the week, which I absolutely could have, but I didn't sell much premium in the S&Ps later in the week, predominantly because I wanted to see what the bond markets were going to do like Monday and Tuesday. And speaking of which, we're going to get more Fed speak throughout the course. Early in this week, Jerome Powell will be speaking. Maybe, just possibly, he'll talk about the fact that, no, I was not dovish. I doubt we'll hear that from him. All right, let's wrap this up here looking at the SPX, all right, which we've basically been talking about. So the SPX, the mother of all products. So the SPX, all right, in the week was looking for approximately a $96 move. Now, again, I'm just going to kind of zoom into this to give you kind of the full Monty, if you will, of how significant the move is. As I was saying, the move that occurred, we were already in rally mode on Monday and Tuesday. We are just shy of the upper edge of an expected move. Now, it doesn't do it justice looking at this, because this week we were looking for a $96 expected move, and we had done most of that move before the Fed even spoke. The Fed, as I said, just poured fuel right into that fire. We explode to the upside, and it's a bit of upside insanity. It's about a 240 point move when you're expecting about a $96 move. So, lo and behold, 2.5 standard deviations. And that literally is like looking at a bell-shaped curve. You're looking for this $96 move, okay, or double that, which is 200. Yeah, you're somewhere out here in like Never Never Land, to the upside. Not quite 3 standard deviations, but people not far from it. Again, if you were to look back over time, and you'll see some big breaches in this marketplace. And again, I've got years and years of data. You look back and you'll see some pretty vicious moves over time, but this is it. This is one of them. And that's why I said you can look back for a significant period of time and not see a breach to the upside or downside of this significance. And that's why I entail this as this is volatility. Right? It's volatility at its best. Doesn't matter what you think. Okay, it's what you see on the screen. And what you're seeing on the screen is very quantitative when we're starting to talk about expected moves. The other aspect that really resonates with me, as I was saying to begin this video, is look at the number of breaches. And these, they don't look significant, but they are. They don't look significant because this one's massive, but the number of breaches, okay, of expected move is alarmingly large. This also would tell you that selling short duration options would be horrific. So the markets, again, this past week, we're looking for a $96 move to get about a $240 move. Now, moving forward, which is always going to be the most important, okay, now we're sitting somewhere very close to about an $80 expected move. So even after seeing, 240 point move, the market's, it's all right. It's only 240 points, but the volatility got crushed a little bit. Now we have an $80 expected move. And I'm just going to throw this out here for your consumption. There's no way you want to sell options in here. You want to be on the buy side of options in the short duration. If you're going to trade short duration options, be on the buy side of it. Long gamma is the place to be in those short duration options. All that 0 DTE, you want to be on the buy side of it this week, unequivocally on the buy side of options throughout the course of this week, because if the squeeze continues, okay, look, it's only 80 points, and 80 points is nominal in comparison to the move that you've seen. And that's one of the key takeaways from looking at this expected move is, hey, frankly, the SPX has not done a great job of handicapping forward risk. And you're in a period of time where like that efficiency of markets is getting ripped apart and getting stressed. That's why I think this is going to be actually a rather interesting week. This week, right off the bat, it's going to go one of two ways. Bonds start to sell off, the volatility is going to pick right back up inside of the S&Ps, okay? Or you'd think like, oh, right, maybe after this substantial move, the markets are just going to completely and utterly mellow out. I don't think we're going to go that way. I think we're still going to be very, very data dependent. I think anything that the Fed says is going to be read deeply into, and I think you should prepare yourself for a bit more volatility. That volatility, again, to me, now it implies movement. It's not just about, look at the VIX, okay? It's implying, again, wild and woolly moves on either side of the marketplace, which are incredibly opportunistic for those of us that are selling premium, those of us that are scalping on an intraday basis. People, this is the market that you asked for. Anyway, with that, thanks everybody for tuning in to this weekend's update. Have a great rest of the weekend. Bye-bye.